What if the safe investment in your portfolio was quietly doing less for you than you think? Not just underperforming, actually failing to preserve your purchasing power. For decades, bonds have been presented as the conservative backbone of investing. Stable, reliable, sensible. But over time, the real question is not how safe they look. It is what they actually delivered. In episode 1, we explain the mechanism. When interest rates rise, bond prices fall. In this episode, we move from theory to results. No spin, no smoothing. Just 25 years of performance across the US, Europe, and Switzerland, and what those returns meant after inflation. Because nominal returns can give a false sense of security. From January 2000 to 2025, AA-rated government bond funds with coupons reinvested returned. Bloomberg US Aggregate AA 231%. Euro Aggregate AOR plus 88%. Swiss Bond Index AAA plus 67%. On the surface, that does not look terrible. In the US, more than doubling your money over 25 years sounds acceptable. But that is only the starting point. Those are nominal returns. They do not reflect inflation. And inflation is the difference between money that looks like it grew and money that actually buys more. This is one of the key distinctions we explore with our community on Patreon. The gap between reported performance and real purchasing power. If you want deeper analysis on economics, geopolitics, and financial decision-making, the link is in the description. Now adjust for inflation. Over the same 25 years, cumulative inflation was roughly 90% in the US, 65% in the Eurozone, and about 20% in Switzerland. That turns the US bond result into roughly plus 20% in real terms, less than 1% per year. In the Eurozone, the plus 108% nominal return is almost entirely offset by inflation. In real terms, the result is close to flat. Switzerland looks better because inflation was lower. But even there, the story is not as simple as it seems. From 2015 to 2022, Swiss yields were negative for long periods. That meant many investors were accepting a real loss from the outset. Now compare that with global equities. Over the same period, the MSCI World Index returned approximately 498% nominal. That is around 200% in real purchasing power. Not a hedge fund, not leverage, not speculation. Just a simple, globally diversified equity index. So the contrast is hard to ignore. The asset class commonly described as safe delivered about 20% real growth over 25 years. The one described as risky delivered around 200%. That does not mean bonds have no place in a portfolio. Risk tolerance, time horizon, and liquidity needs still matter. But it does mean investors should be clear about the trade-off. Because if an asset protects you from volatility while slowly eroding your purchasing power, the word safe deserves more scrutiny. In episode 3, we turn to the crashes. Because bonds do not just underperform. At certain moments, they break in ways most investors do not expect. The worst bond year since 1788 is next. Subscribe to Curiosity Matters and join a community that prefers evidence over convention. And if you want the deeper version, economics, geopolitics, and practical financial analysis, join us on Patreon. That is where we go beyond the 5-minute format. See you in episode 3.